Hi, good morning. Thanks for joining us for our Monday Phillip Securities Research Morning Call. Today we have a lot on the agenda. Apple, Netflix, Facebook, followed by Keppel DC REIT, Fraser Centrepoint Trust, and then Phillip on ground for IFAST, Japfa, and then SPH, and Sheng Siong's results. And we end with Singapore Weekly Week 44. Without further ado, let's move on. Our first item is Apple's fourth quarter 21 results, titled Supply Constraints but Demand Strong. So recently, Apple released their results on Friday. Results were in line with our expectations. So the full year revenue and PATMI were at 100% and 101% of our FY21 forecast. And gross margins were at a 7-year high of 41.8%. So we start off with the positives. The positives is that we still see robust iPhone demand. So for the iPhone 13, which was launched just last month, or in late September, the pre-orders were 20% above the iPhone 12, which was launched last year. The upgraders and switchers also grew double digits. Upgraders are people who upgrade from an older iPhone model, and a switcher is someone who switches, like let's say from Samsung over to Apple. And the positives for the iPhone is that for Apple in the quarter, their smartphone shipments were up 14% year on year, mainly from a lot due to the demand from the iPhone 13. Whereas for Samsung, which is Apple's closest competitor in the high-end smartphone market, their shipments fell by 13% due to supply chain struggles. So because of Apple's supply chain dominance, their worldwide smartphone shipment market share actually jumped from 12% to 15% year on year. And we think this has hit more upside to grow moving forward as the supply chain issues linger. The second positive is the services growth beat expectations. So for the fourth quarter, services revenue was up 26% compared to a forecast of 18%. And this is important because services contribute 70% margins, double what the product margins offer. So like iPhone, they provide about 35% margins. So actually this helps to boost Apple's margins up to 7-year highs of 41.8%. So the main negative for Apple is the supply chain constraints, which was larger than expected. So they were impacted. Revenue was impacted by $6 billion in the quarter, or 9.3%. You can see the chart on the left, the revenue. So this was mainly due to manufacturing disruptions and chip shortages affecting all of affecting iPhones, iPads, and Macs. And the chip shortage will likely persist and will become more acute during the holiday season, especially when the sales volume spikes. So for the outlook, the outlook is just the supply chain constraints is going to linger, and the impact is guided to be higher than $6 billion in the next quarter. But the positives is that the gross margin guidance is still elevated at 41.5% to 42.5%. So this is a material increase still year on year from last year, year on year, and it's materially higher also than the 5-year average margins of 39%. And these margins already factors in the higher freight costs that Apple is impacted by, and also the various new product launches that incur higher marketing costs. So we maintain buy on Apple with an unchanged target price of $187, mainly due to the strong demand we see in Apple's 5G models, so the iPhone 13 and iPhone 12. And iPhone 13 pre-orders are 20% above iPhone 12. So the main problem is the supply chain issues with regards to the semiconductors. So we're estimating 2.8% iPhone sales growth for the next year. and this is already off the very high base that they saw this year, this whole year, from the iPhone 12 launch and also the iPhone 13. So we still expect growth of 2.8% next year. So a potential near-term catalyst we see is a successful appeal again to delay the App Store ruling coming to effect on the 9th of December. So the background for this ruling is that for those App Store users, people who use the App Store, the ruling says that the ruling gives users the option to make payment outside of the App Store. So that means that Apple may not get a cut of the payments that they make outside. Usually, Apple takes a cut of 15 to 30% of whatever people spend on the App Store. So if this ruling comes about, then people may start paying outside the App Store. But we're still not clear on whether they will do that or not. But the revenue impact of people paying outside the App Store could impact about 2% of revenue or 4% of gross profits. So if Apple manages to successfully appeal against this new ruling, it could delay it for several years. And this is positive for Apple with regards to the earnings that they can get from the App Store moving forward. With that, pass my time on to John for Netflix.
Thanks, Tim. Good morning, everyone. So we'll begin with the Netflix third quarter results for FY21. So generally, the results for the quarter came in above expectations, with year-to-date revenue at 75% of our full-year forecast, and year-to-date PATMI at 101% of our full-year forecast. So moving to the positives, Netflix kind of saw a really strong demand in services for the quarter, adding 4.4 million users to their membership base. This, if you can see from the chart on the left, 4.4 is a 184% increase quarter-on-quarter and a 99% increase year-on-year compared to the third quarter of last year. And this was mainly led by their hit series of Squid Game and Money Heist. Most of their membership growth actually came from the Europe, Middle East, and Africa and Asia Pacific regions. So moving to revenue, revenue was boosted by rising prices and increasing memberships. So revenue, if you look at the chart on the left, revenue for the quarter came in at 7.5 billion, 16.3% year-on-year increase, and almost a 2% quarter-to-quarter increase. So for ARM, which is the average monthly revenue per membership, essentially is your pricing. ARM ended the third quarter at $11.80 US dollars, which is an 8% growth year to date. It's on track to hit our 10% growth estimates for full year FY21. So our last positives is that Netflix actually made a couple of strategic acquisitions to boost their future content creation. So they acquired the Road Dial Story Company and Night School Studio, which is a video gaming developer, to kind of boost their IP library and video game kind of capabilities moving forward as it's moving to gaming. Onto our single negative, which would be a soft quarter-on-quarter guidance for EPS and PATMI for the next quarter, which we'll discuss in Outlook. Next slide, please. So generally, the fourth quarter is the strongest quarter in terms of growth in memberships and ARM. And we do still expect fourth quarter revenue to increase quarter-on-quarter. So this year shouldn't be any different in terms of revenue. But for PATMI, net margins and EPS, it's going to be significantly lower due to increased content costs. And this is because there's going to be a unusually large slate of content releases scheduled to for the fourth quarter of this year, just mainly due to kind of production delays from dating back all the way to the 2020 COVID kind of disruptions. So they're kind of just releasing everything, all their content in the fourth quarter, and the way that Netflix does it is that they incur costs or they record down that cost based on when these contents are released. And so therefore, if you have more contents being released, more cost is going to be involved in that particular quarter. And that's why you can see on the chart on the left, PATMI is 33% down year on year. So actually these numbers are rounded up, for the fourth quarter of 2020, PATMI was actually $542 million US dollars, but the company actually guided this fourth quarter to 365 million US dollars. So that's actually a 33% decrease. Net margins are also going to be decreasing significantly from 8.2% to 4.7%. Moving to the ratings, we still maintain our accumulate rating with an unchanged target price of $724. We do raise our FY21 PATMI estimates 9% to 4.9 billion US dollars based on lower than expected interest expense and effective tax rates for this year so far. So we have an unchanged target price as our FY22 assumptions remain unchanged. Moving on to Facebook, which is our next company. So Facebook's third quarter results were largely in line with expectations. Revenue, year-to-date revenue is 73% of our forecast, and year-to-date PATMI is at 78% of our forecast. In general, most of the numbers saw like quarter-on-quarter declines, but in terms of year-on-year growth, it is still fairly strong. Most of the numbers like your revenue, PATMI, it's all growing at their high teens to 30% kind of range, which is still strong. Moving to the positives, Facebook actually still demonstrated their strong network effect, even in the face of a lot of negative publicity, growing their MAP, which is their multi-active people, which is essentially the number of users that had used their family of platforms in the last 30 days. So they grew at 70 million in the third quarter this year, which is a 2% quarter-on-quarter increase and 11% year-on-year increase. So they also continued to invest in their own IT infrastructure, growing their capex 23% year-on-year. And even though it's a slight negative quarter-on-quarter, the company actually already guided for full year FY22 capex to be in the $29 to $34 billion range. So we should see this continued trend of investing in their infrastructure continuing moving forward. For the third quarter of this year, they also bought back a significant amount of shares. They spent almost $14 billion buying back shares, which basically boosted their EPS to $3.22, narrowly beating consensus estimates by 5 cents. So in terms of the negatives, we saw rather lower than expected revenue numbers for the quarter, mainly due to privacy headwinds relating to Apple's iOS 14 privacy changes. So other factors are also moderated growth in e-commerce, supply chain disruptions, and reduced economic activity in the APAC region due to the resurgence of COVID-19. Moving to the next slide, please. In terms of outlook, Facebook actually plans to separately report Facebook Reality Labs, or FRL, which is their AR/VR segment. And this is mainly just to provide a bit more clarity and information regarding the performance of this particular business, which is also in line with the company's kind of strategy moving forward. They kind of want to spend and have been spending a significant amount of resources in AR and VR. And they've been talking quite a bit about their metaverse and all these kind of things. So it's just, I guess it's just for the company to separate it, provide a bit more clarity. In terms of the fourth quarter is seasonally the strongest quarter of the year, similar to Netflix. It is pretty much just due to increased advertising spend, just due to the holiday season across the world. But the company guidance for revenue was quite muted at $31.5 to $34 billion range, which represents like a 12 to 21% year-on-year growth. So even though the guidance was pretty muted, it's still not, if you compare it to the rest of the quarters, which is usually growing at like 30 to 35% growth rate, it's definitely a lot less, but it's still, in general, it's still considered a pretty decent amount of growth. So far this year, we've seen a strong MAP growth, which is their monthly active people, so their users. So right for ending the third quarter of 2021, Facebook recorded 3.58 billion users, which is very close to our full year estimates of 3.6 billion. So we expect this metric to hit our forecast quite comfortably. Just our last kind of outlook, Facebook is actually changing their company name to Meta and changing their ticker to MVRS, so short form for Metaverse. We still maintain our buy rating with an unchanged target price of $424. We're still bullish of the company's business metrics moving forward, and that's why our assumptions for FY22 remain unchanged. That's all for Facebook. I'll pass my time now on to Natalie. Thank you.
Thank you, Jonathan. Good morning, everyone. So I'll be talking about Keppel DC's third quarter business update. First of all, DPU for third quarter grew by about 4.5%. This is on the back of acquisitions and AEIs. So if you look at the graph table on the left-hand side, the acquisitions that contributed to this growth in DPU or growth in revenue that led to DPU growth were Amsterdam DC and Eindhoven campus. This was acquired in December 2020 as well as September 2021. And the AEIs that contributed were Keppel DC 5, Dublin 1, Dublin 2, and DC 1. Okay, so for the 9-month DPU, it comes in at about 7.386 cents, and this was in line with our estimates, forming about 75% of our FY21 estimates. 3Q was a fruitful quarter of capital recycling for Keppel DC. So far, year to October, they have announced 3 investments, and this totaled about $281 million with a weighted average yield of 8.3%. So we estimate that this will actually, these acquisitions or these investments will contribute about 6%, more than 6% to DPU accretion for KDC. They also announced the divestment of iSeek Data Center, or rather they completed the divestment of iSeek Data Center for $35.3 million. And this was about 21% above the IPO valuation and 1.4% above market valuation, respectively. Portfolio remains stable, interest coverage ratio high at 12.2 times, gearing is a manageable 35.1%, and WALE is long at 7 years. On the negative side, Keppel Basis Bay Data Center, which is a data center in Malaysia, has a lease that is expiring in about 8 months. And we think that this lease may be at risk. So this asset has actually faced a little bit of leasing difficulty. Occupancy has been at about 63.1% since 2Q 2017. However, due to the growth in AUM, this asset currently only contributes about 1% to NPI. Okay. In terms of outlook, Keppel DC is currently evaluating several on and off market deals with cap rates ranging about 4 to 5%. And due to its low cost of borrowing at about 1.6%, this leaves a lot of room for accretion. Yeah. Overall, we maintain our accumulate and we shift our target price slightly. Next slide, please. Okay, so just to take some stock about how our target price actually moved. Our previous target price of $3.20 actually includes an assumed acquisition of 500 million Singapore dollars at a yield of 6%, and that is expected to be completed in the fourth quarter of 2021. Okay, so year to October, the three investments that have been announced, that totals about $281 million. At an average yield of 8.3%, and this will actually contribute a full year EBITDA of about 23.2 million, and that compares to our assumed acquisition of about $30 million. So overall, we're in terms of full year contribution, we're slightly off. So what we are actually doing right now is that we are removing this assumed acquisition and penciling in the acquisition of these 3 investments. Yeah, so with that, our DPU actually dips slightly, 0.3% and 4.1% for FY21 and 22, and this reduced our TP by about 5.3%. Overall, for FY21 and 22, we're expecting DPU yields of about 4.1% and 4.5% respectively. Okay, next slide, please. Next, we have Fraser Centrepoint's full year 2021 results. So starting off with the table on the left-hand side, you see that gross revenue grew by 107.5%. This was due to the full year contribution from the acquisition of a 66.11 stake in ARF on October 2020. Okay. This was partly aided by lower rental rebates given by FCT. So rental rebates for the year came in at about $9 million. This is one third the amount of rental rebates that was given last year. Okay. And of course, revenue was partially offset due to loss of income from the divestment of 3 malls, Bedok Point, Anchor Point, as well as UT Point. Okay. So overall, we see that DPU actually grew by 33.7%. And also the DPU came in line with our estimates, forming about 99% of our estimates. On the positive side, NPI margin has recovered back to pre-pandemic levels. So historically, FCT's NPI margin has always been about 70 to 72%. For the full year of FY21, NPI margin is about 72.3%. And this was, the improvement in NPI margin was due to lower, rather cost containment initiatives and as well as lower marketing costs due to the absence of atrium events. So because there was no atrium events that happened in FY21, there was no need to do any marketing for these events. So therefore, there was a cost savings on that front. Moving forward, as the economy reopens and as atrium sales are expected to return, the FCT is expecting to incur some marketing expenses. However, the increase in marketing expenses is expected to be offset due to the contribution of returning atrium revenues. So therefore, margins are expected to be stable, and they are aiming to keep it between 70 to 72%. Okay. Retail occupancy also recovered 0.9 percentage points year on year to 97.3%. So this is actually back to pre-pandemic levels. Okay, and occupancy improved across 6 out of 9 of FCT's malls. Yeah. So we'll just like talk a little bit. I'll elaborate a little bit more about some of the malls that are actually facing a little bit of trouble for FCT shortly. Okay. In terms of the negatives, reversions was negative at 0.6%. And this was weighed down by 2 main assets, CCP, Changi City Point, as well as Century Square. So Changi City Point is an asset located near the Singapore Expo. And so it actually benefits from the events that are taking place at the Singapore Expo, which it used to take place almost every week. The trade shows or events or etc., as well as there's the business parks that are actually located in Changi. So CCP was affected by lower footfall due to the absence of these kind of events, as well as work from home amongst the business park kind of tenants. So that actually resulted in a weaker leasing, a bit of uncertainty with regards to the tenants who have leases expiring at CCP, and therefore it registered a negative rental reversion of about 9.8%. For Century Square, this asset is located in Tampines, and for FY21, unfortunately, it was a very lumpy year of expiries for Century Square. This is because the mall actually underwent repositioning three years ago. So there were a lot of leases that were expiring 3 years later. And due to the situation that we are currently in, we're still sort of in the throes of the pandemic. This actually also resulted in slower absorption and a bit of a cautiousness from the tenants, and that led to a negative reversion of 2.8%. So for the remainder of FCT's 6 out of 9 malls, these malls actually managed to register positive rental reversions. Okay. Portfolio valuations slid very marginally, about $8 million or 0.1% of AUM, and this was attributed to these 2 malls, CCP as well as Century Square. Okay, the rest of the assets actually remained very resilient. Their valuations were unchanged from pre-pandemic levels, and in fact, Causeway Point, the asset that is located at Woodlands, actually registered a valuation growth, or rather valuations improvements in 2020 as well as 2021. So overall, we can say that the suburban malls have been very resilient. Tenant sales also declined in July and September, but this was of course due to the tightened restrictions that were happening in these months, and it affected I would say all the malls equally. Okay. In terms of outlook, the management is seeing stronger demand from F&B tenants, but that doesn't mean that there's no demand from other trade sectors. They are also seeing demand from grocers as well as trade fashion retailers. Occupancy costs, which is a measure for tenants, comparing the cost of renting a space, a physical space, to versus the revenue generated by that physical space. So that's the occupancy cost. It has come down slightly from 19% in FY20 to about 17% in FY21. So overall, what we are understanding from this is that occupancy costs remain healthy, and it points to sustainability of rents. We maintain our accumulate call with a slightly lower DDM target price of $2.83. Previously, it was $2.87. And we reduced our earnings very slightly by about 5.8% to 6.6% due to factor in a more conservative pace of rental growth. Okay, so that's all for me. I'll now pass the time on to Glenn.
Thanks, Natalie. Next slide, please. Oh, thanks. Okay, so for the IFAST 3Q 2021 results, the group's assets under administration in the AUA grew to 18.38 billion as at 30th September 2021, which indicated a growth of 46.1% year-on-year and a growth of about 27% year-to-date. If you take a look at the chart on the right, the group's AUA is at an all-time high. And the breakdown of the AUA is about 70% for B2B and 30% for B2C. The AUA of the group's unit trust, which is its key investment class and takes up about 73% of the group's AUA, also grew to a record 13.46 billion, representing a growth of about 39% year-on-year and 23% year-to-date. The group's unit trust subscriptions grew 35% year-on-year to 5.5 billion for 9-month 2021. The net inflows of client assets for the third quarter were about 0.9 billion, leading to the net inflows of about 3 billion for 9-month 2021. And this is 29% higher than the net inflows of 2.31 billion for 9-month 2020. For the group's net revenue, it grew 38.1% year-on-year to 85 million in 9-month 2021, while net profit grew about 63% year-on-year to 23.43 million. And its recurring net revenue increased 29% year-on-year in third quarter 2021 and 32% year-on-year in 9-month 2021. This growth has resulted from the group's past investments in building a strong integrated digital wealth management platform. The group's average contribution from recurring net revenue from 2020 to 9-month 2021 makes up about 69% of total net revenue. Revenue is still mainly contributed from Singapore at 55%, but other regions have shown healthy growth, mainly Hong Kong, Malaysia, and China. The interim dividend of 1.3 cents per ordinary share was declared for third quarter 2021, and this was an increase of 62% year-on-year as compared to the dividend of 0.8 cents for third quarter 2020. The group also expects to substantially accelerate the growth of its Hong Kong business in the next 5 years, particularly in 2024 and 2025. Its new e-pension division will start to contribute in 2023 and 2024. So they have shared their targets, and they have mentioned that the e-pension division will involve the operation and administrative services for the MPF schemes in Hong Kong, which will be the main contributor, as well as the Occupation Retirement Scheme Ordinance. And however, this division will not add to the group's AUA numbers, but will add a strong stream of recurring service fees to the groups. So they have shared their guidance for the targeted numbers they want to achieve for Hong Kong. For comparisons, currently for 9-month 2021, the group's overall Hong Kong business has achieved net revenue of 106 million Hong Kong dollars and a profit before tax margin of 35%. The group targets to achieve net revenue of more than 800 million Hong Kong dollars in 2024 and more than 1.2 billion Hong Kong dollars in 2025, and PBT margins of more than 15% in 2024 and more than 33% in 2025. This is expected to add profit of more than 21 million Sing dollars in 2024 and more than 69 million Sing dollars in 2025. They have also shared their 5-year plan with the 4 pointers on the right side of the screen. So I've shared about the accelerating Hong Kong growth. The other point, it would be to get bigger and better. So they plan to continue to increase the scale and quality of their fintech wealth management platform in various markets, which is in line with the group's target AUA of 100 billion Sing dollars by 2028. This AUA of 100 billion implies a compound annual growth rate of about 27% from the group's current AUA of 18 billion. They also intend to take on more licenses. The group is expecting to be pursuing more financial licenses in different jurisdictions and make strategic investments in adjacent fintech capabilities. One of the licenses they mentioned that they are pursuing would be a digital banking license, and are looking to have their digital banking capabilities in 1 or more jurisdictions. Also, the group is in the midst of applying for a recognized market operator license in order to operate a bonds marketplace, which is similar to an exchange for bonds. Lastly, they shared about their truly global business model, where the group is targeting to make tangible progress towards its vision of being a fintech wealth management player with a truly global business model focused on helping investors invest globally. So this truly global business model are those that can operate from just 1 or a few countries, but serve customers from around the world. So for example, for music streaming, there is Spotify, and video streaming, there is Netflix. However, they have stated that this is more of a long-term target and not really a short-term one. So that's all for IFAST. I'll be handing over to Vivian.
Thank you, Glenn. This is an update on Japfa's 3Q21 results. So firstly, if you refer to the graph on your top right, on a year-on-year basis, revenue grew, but PATMI fell. So just wanted to show that on a quarter-on-quarter basis, there was a slight decrease in revenue. And this could be mainly also attributed to the fact that for 2021, all the reporting quarters so far, the sales volume has been higher than that of 2020. And that said, even though quarter-on-quarter revenue is down, they have managed to achieve stable sales volumes for all segments. And this includes animal feed, dill, chicks, broilers, swine fattening, etc. For Japfa, the sales of animal feed also remains the pillar of profitability, but high raw material costs are impacting their margins. So on a PATMI line, you can see that they suffered a net loss of 5 million for the reporting quarter. So zooming into the various segments, firstly for PT Japfa TBK, under which they sell animal feed, DOCs, and also broilers, mainly in Indonesia. This segment recorded higher revenue due to the fact that on a year-on-year basis, you can also refer to the chart on the bottom right. Comparing 3Q21 and 3Q 2020 prices, it was slightly higher, but on a quarter-on-quarter basis, the prices fell mainly due to the fact that with the movement restrictions, there was a significant drop in demand due to the shopping malls, food stalls, and restaurants closed. So broiler prices fell below cost in 3Q. Feed margins were also tightened as mentioned due to high feed raw material and also shipping costs. On the other hand, poultry prices remained fairly stable. So the main reason why sales has also remained stable is that these are considered to be perishable goods. For example, your dill, chicks, and broilers that have to be sold within maybe a maximum time frame of around a day or 3 to 4 days. Otherwise, the company could incur even higher costs. Next, for animal protein other, or APO, which they sell poultry and swine and also animal feed, mainly in Vietnam and a bit in Myanmar. The broiler prices also fell below cost and swine prices dropped as compared to 3Q 2020, when the prices were exceptionally high, caused by the shortage in supply due to the African swine flu. So similarly for Vietnam, the consumer demand also dropped for poultry or chicken, as chicken is a low-cost staple food primarily consumed in canteens, in factories and schools which were closed. And similarly, feed margins were also tightened. The impact from Myanmar is quite limited, as Myanmar only made up around 2% of the revenue. And they have also been cutting down on the operations and streamlining operations and production. Lastly, for the dairy segment, which is primarily in China, there has been additional contribution for this quarter from Farm 8 and also the two new additional farms, dairy farms acquired in Shandong. So China's raw milk supply remains in shortage as the demand continues to grow. And for Japfa, through Austrasia, which is their dairy segment, they have been continuing their supply expansion plans, including establishing new strategic partnerships and also the acquisition of the 2 dairy farms in China. Looking ahead, movement restrictions have since eased in Indonesia and Vietnam, but it will take some time for the prices to stabilize. So that's all for Japfa. I'll now be handing over the time to Terence for SPH.
Yeah, thanks, Vivian, and good morning, everyone. SPH received a competing offer. Sorry, next slide. Sorry, just wait a while for the slide to change. Okay, thank you. SPH received a competing offer from a consortium comprising of hotel properties and the Temasek Link units CLA and Mapletree last week. The consortium, comprising Hotel Properties Limited, businessman Ong Beng Sing, and 2 Temasek Link entities CLA and Mapletree, are proposing to acquire SPH at $2.10 per share in cash. The offer has been submitted to the SPH board for all the shares of SPH via a scheme of arrangement. Just some background of the consortium. The consortium vehicle, Cascaden Peak, is 40% held by a HPL unit called Tiger Stars. It is 30% owned by Temasek Link unit CLA Real Estate Holdings, which owns the property group Capital Land. It is the majority owner of Capital Land Investments and is also 30% owned by the Mapletree Group, which is Temasek Link. To recall, there is an existing offer from Keppel Corp for SPH. The privatization by offer from Keppel Corp is valued at $2.09 per share. This $2.09 per share is comprises of a cash component of 66 cents 8 in cash, 0.596 Keppel REIT unit valued at 71.5 cents per share, and 0.782 SPH REIT unit valued at 71 cents 6 per share. Also, as part of the offer, there is a breakup fee of $34 million payable by SPH if a superior competing offer emerges that the independent directors deem more favorable for shareholders. So, for perspective, this 34 million should, in the event, not saying that it would necessarily happen, but in the event that the deal by Keppel Corp does not go through, this $34 million represents about 1.5 cents accretion to their EPS for financial year 2021. So in our next slide, in terms of what's going to happen next, we see the next steps that are going to happen. Yeah, so we will just wait a while for the slides to change.
Terence, the slides are changed already, but
okay.
Not changed yet, is it?
Yeah, it's not changed on my side.
Let me stop sharing first. Yeah.
Okay. Okay, I see it changed. Thanks.
Okay, good.
Thanks, Tim. So in terms of the next plans, Keppel, under the terms of the agreement, Keppel has the option in the event a competing offer emerges to make a voluntary conditional cash offer for SPH in lieu of proceeding with the acquisition by way of scheme of arrangement. So Keppel has 10 business days to improve its proposal. The consortium Cascaden Peak may also need to make a chain offer for SPH REIT if they acquire SPH. So the offer that the consortium will need to make is based on the VWAP for the last 20 days, and this is 95 cents 7 for SPH REIT. This does not represent an offer, but this is just the VWAP for the last 20 days. In the event of a competitive standoff between the two parties, then the offerers will be required to go through the auction procedure in order to provide an orderly framework for its resolution. So on this image here on the right-hand side, we provided a image or this screenshot of the mechanics of the auction procedure. Sorry, it's a little bit small, but let me just try to bring you to this. So in the event of that the deal reaches an impasse, then where the two offerers are in a competitive standoff because of the offer and they cannot reach and there's no finalization of the offer, then when shareholders cannot decide on the two offers, then they will reach a auction procedure. So if you look at this timeline, you can ignore the day here. Then, but when you look at the second day here, the day 46, both offerers A and B will need to submit their revised offer announcement to the council. So when they submit the offer, this will be posted on the SGX net at between 5:30 to 6 p.m. The new revised offer from offerer A and offerer B. The offerer that is offering lesser than the other offerer will have until the next day to submit the revised offer. So if you look, you just go down the timeline here, you see day 47, offerer A, because offerer A's offer is lower than offerer B, offerer A have until the next day to submit the revised offer to council. Then they have, for offerer B, they have one more day. So if you look, again, going down the timeline here to day 48, again, just ignore the day, but the offerer B has until one more day to submit the revised offer to the council. And this process will keep going on until one of them decide not to revise the offer. Then the final offer, that is the highest offer, will then go through. If I understand that it can be a little bit confusing, but if you need more clarification, I'm happy to take the question during the Q&A. So that's all from me. I'll now hand over the time to Paul.
Thanks, Terence. Next slide. Okay.
All able to see?
No, I can't really see the slides. Yeah.
Can someone else share the screen? I think something wrong with mine.
Okay. Yeah, I can see now. Can you go to the previous slide now? Who's controlling it? Oh, but I think it's okay. It's okay. Just leave it. Okay. Anyway, Sheng Siong released their third quarter slides. Sorry, third quarter results. For us, the numbers definitely beat our estimates. I think the numbers was about 10 to 15% higher. What happened was that if you look at the positives, what happened was the margins hit a record high of 29%. I think pre-pandemic was probably about 27%. The reason is that when the Jurong Port fishery port was closed, and to a certain extent Pasir Panjang, and also more importantly was the fear as cases went up, everyone was fearful of going to the wet markets. So that drove out a lot of demand for fresh food into Sheng Siong stores. And fresh food always has the highest margins. So that was the main positive, and that's why you can see the numbers beating. The negative, this is the negative for the last 4-5 quarters since the pandemic occurred. They've not been able to secure any new stores. So far, probably only next year HDB will bid out for 6 stores in 2022. And the reason is because there are lack of workers and then there's inability to build out HDB units and so forth. The only positive, I guess, is that it's not affecting other competitors. So the 9 months actually beat our numbers by roughly 15-20%. So it's quite a huge beat. In terms of the outlook, no new stores will be a dampener. But I think for us, this results just shows the strength of their fresh food supply chain. So Sheng Siong actually also sources from Jurong Fishery Port. But what happened is that they are able to source it directly from suppliers. I'm not sure. I think it's wholesalers, could be even fishermen. I'm not very sure, but that was their strength. So they were affected by because of their size. So in terms of the outlook again, it just shows that their ability to source directly and diversity, because they take from multiple countries, scale, and also the key is that they frequently refresh their inventory for fresh food. So this gives them a competitive edge. So as our report title, what we think is that the circular trend of them taking market share from wet markets, especially on fresh food, has further accelerated because of this event and probably the whole pandemic. So this should actually continue or persist even as we go into a post-pandemic phase. We upgraded to a buy, but that's mainly because the share price came off. We are valuing it on the we are valuing on 25 times FY22, so no change in it. The attraction is their ROEs are high, dividends and net cash company. But admittedly, there is some uncertainty. I think as we move into FY22 post-pandemic, there's a bit of there's no certainty how they're going to perform in FY22. It should still hold well, but I guess that is going to be the overhang in the near term, because as we go to when borders reopen, there's less clarity how supermarket spending will trend once the borders open. But we have a buy and no change in our target price. So that will be the uncertainty will be the headwind. Next slide. Okay. Yeah, sorry for the technical issues. Okay, next slide. So we just go very quickly for the weekly updates. Next slide. I can't, let me just share some myself. Is there a slide thing? Never mind, let me do it myself.
Paul, are you able to see my slides?
Yeah. Never mind, let's keep let's go Q&A. Let's go Q&A. Let's end it now. Let's go Q&A.
Okay, then I guess I'll start now first for the Q&A. Is it okay, Paul?
Yeah, go Q&A, it's wasting time.
Okay, so there are a few counters that I've been looking at. So let me just do a check first. Okay, so we're sharing these technicals. So first up will be Del Monte. So Del Monte, you can see that prices has been, I issued a report on the inverted head and shoulder. Price did a buy stop of 0.4. And then after that, price corrected, but it didn't hit my stop loss. Right now, price has already ascended back above the Kumo. Kumo bullish squeeze, all these are, support above Tenkan-sen. These bullish channel, you can look at it as a larger bullish flag. Once it clear 4.30 upper resistance bound, we can ensure that there will be a continuation of upside. All right, so this is basically the Del Monte. Okay, so there's a question on Genting. So Genting is a bit tricky. So since after it breaks out of the descending rising channel, we as price did rebounded, double bottom, clearing. So, but this consolidative kind of like candles, a lot of shadows. Is making it unsure that what's the direction of Genting moving forward. But you can see that there is immediate support over here at 0.755. So, and in any case, as long as 0.755 is supported, we should see a minimum midterm target to 0.84 to 0.855 resistance target zone. Okay, so this is what we expect. Looking at the longer term, we are still on the very much of a stronger downtrend at the moment. Okay. So let's move on to the Hong Kong stock. So Hong Kong Hang Seng TECH ETF prices came down after breaking out of the smaller inverted head and shoulder 13.56 resistance. Prices has been trending up. We expect price to eventually reach a target at $14.68 to $15.19. But I want to bring you closer to what the price is here right now. Prices is testing the immediate support at this level, 13.05 to 13.07. So this level will likely be supported, as we can see that from the hourly chart. There is some sort of like a reversal kind of pattern at the near support. Intraday bullish pin bar. But however, if this open up and close with a bearish candle, then we expect that price is going to reach for a deeper pullback retracement at least to 12.55 to 12.92 major support region. Okay, and then this might form a triple bottom before breaking up to the upside at 14.68 to 15.19. This is the likely scenario. Okay, prices just break below the 50-day EMA, so gap below. So likely we can going to see that this is the latter one, and then before going up again. Great Wall Motor at the same we have a rounding top. Intraday is showing a bit of an inverted head, larger head and shoulder. Okay, prices is likely to find support at $31 support zone, pull back to the base of the flag before a rebound. So once the rebound happens, then we will see further upside. So right now you can see that prices is testing between 37.50 to 39.05 resistance area. Okay, but just that we expect some sort of like a light pullback before embarking to the upside again. Tencent, last week I mentioned, I think I shared this. I think I shared this on the Telegram live last week. So price actually was hovering. We expect some form of hovering for Tencent holding. The tech sector in China, we are expecting some sort of like consolidation. We are not out of the woods yet. Prices is likely to hit down to support at 440 to 455.2 before the rebound to the upside. Okay, should that happen, this will be likely a ascending triangle that we see. Okay, so you can see that this, you can follow my outlook, my tracing, the upward sloping line, the horizontal resistance level that has been tested quite a number of times, 3 times to be exact, including a false breakout. Okay, so this is likely a trend that we are seeing right now. Moving on to IFAST. So IFAST is coming down. Correction has already started since it's confirmed the double top and then the larger ascending rising wedge price has broken down below 8.98. So we can see that there's a confirmation of the double top formation. Likely we're going to see this support region going to have a slight pullback back to the origin at 9.01 before embarking to one more downside to the major support at 7.56 to 7.89. All right, if you're going to look at the what's it called, that the Fibonacci extension, we can see that the true $7.81 is actually 200% of the extension of the double top formation. So likely this is we are looking at a confluence of the major support zone. So likely we are embarking on a rebound over here, likely. Okay. Next one is DBS. DBS, we are seeing upside break. It has retest back to $32. So you can look at the hourly chart. Since it's breakout above the 4-hour chart, since it breakout of the flat pattern, prices has come sort of like retraced closely this on last week, and then we go back on the rebound for the DBS. Okay, so likely this resistance at 31.68 likely to be well supported moving forward. Okay, so Ascender Street is more of like a range kind of scenario. We expect that $3.15 to be broken, followed by heavily resisted at 3.17 before a pullback back to $3 psychological support, and then before embarking on rebound to the upside. Both the 250-day moving average is showing a tight consolidation, means that not really is really a neutral signal, nothing much. It is signaling that the Ascender Street right now is embarking on a ranging kind of situation right now. Okay, so I expect 3.17 and $3 as a strong rebound to the upside, breaking, and then we shall see $3.40 target in the longer period run. Lastly, will be SIA. SIA, it has a gap up above the ascending triangle, consolidate a while before a strong selling, a deeper throwback to the base of the support of the ascending triangle. Resistance and support is actually at $5.25. But the consolidative and the lack of momentum is actually signaling that, okay, SIA is not really that well performing in terms of any upside. So there's a chance that it might engage in a deeper pullback to $4.93. Furthermore, if I point your attention to the average directional index, the ADX signal. ADX signal has really recently dropped. Today has dropped below 20. So we are expecting some sort of like a non-trending momentum right now. Okay. So Ichimoku wise, you can see that price just trend below the Kijun Sen, which is a first sign of a signal. So any pullback will actually create a Tenkan Sen to actually have a potential to cross below Kijun Sen, forming a death cross. All right, so I want to take the chance to do a bit of sets since it's likely correlated. So for sets wise, you can see that it is closely correlated to the SIA technical analysis. But one thing is we can see that although the sell-down is much more evidently in sets, but you can see that the bullish rebound is much more offering a better chance for up pullback. So, but don't be so too over the joy yet, because we believe that 4.36 is likely to be a zone, a level that will be facing a tough sell-off going forward. Okay. All right, so before I end off, I'd like to see Tencent. Okay, so I'll do the next one. I'll do Baba 9988. Before I pass on my time to my colleague. So Alibaba a failed upbreak. This is a Hong Kong one, by the way. So we are seeing maybe perhaps a rebound, a pullback rebound at 140 region. So we can look at that. Reason why is I think it fails to clear above 180 Hong Kong dollars for now, the psychological resistance. All right. All right. So nice. Yeah. So for CapitaLand Invest, it has broken out of panel, but unfortunately, this shadow, that we are looking at, is not really a good one. It fails to close above the immediate high at 3.54. Despite that, there is some sort of rebound. We are unsure of the clearing yet. Okay, so likely support is at 333, 330, and 335 going forward. Okay, I'll do the next one. Sheng Siong, and then 1799, and then I'll pass my time back as we are running out of time. All right. Sheng Siong. So Sheng Siong broken out of the descending triangle, major support at 1.32 to 1.36 going forward. And then, yeah, so nothing much, confirming the descending triangle. Ichimoku is showing a strong bearish downtrend as well. Okay, 3 bearish depth cross over here. So 1799, double top, breakdown, likely support we are going to find at 1560, but I think that 11.65 to 13.25 offer a better rebound to the upside going forward. Last one is Ping An. Okay, Ping An, rebound, sell down, rebound. So are we going to see upside? Depends on this candle, whether are we going to form a piercing line, and then whether this piercing line candle can sustain a closure above this support at 56.35. This is the most important things right now. Okay, so with that, that's all. And then I'll pass my time back to my colleague. Thank you.
Hi, oh, sorry, Natalie, you want to go ahead first?
Never mind, okay, Glenn can go first.
Oh, okay. Okay, so I think there's 2 questions on IFAST. Just to reiterate, this is a non-rated. So, so the first question is, what is the unique selling point of IFAST that other financial institutions or stockbrokers are not able to replicate or do what IFAST is doing? Is the current high valuation sustainable? So I think the selling point of IFAST is that they have a very strong unit trust. As you can see, I think earlier I mentioned that about 70% of the AUA is from unit trust. So they did mention that they have quite strong stickiness with their current customers, and they have built this platform which has a lot of sort of materials for investors to use. So that's one of the reasons why people keep coming back. And is the current high valuations... Okay, there's one more question about the PE of IFAST. I think it's about 82 times right now. So, and also the other question would be, the second part is the current high valuation sustainable? I think they have mentioned about their Hong Kong project. So it is expected to bring quite a lot of profit. It's 21 million Sing dollar in 2024 and 69 million Sing dollar in 2025. So I think that's one of the reasons why it's currently so highly valued, because of this profit from the Hong Kong project. And I think it's going to run for the next 7 years. So they have released their targets, and that's one of the reasons why. Okay, I think that's all I have for IFAST. Hand it over to Natalie now.
Thanks, Glenn. Okay, I see two questions for me. First one would be, why is on Keppel DC, why is Basis Bay Data Center facing challenges in lifting the occupancy rate from the current 63%? Okay, so earlier the management actually said that there was a bit of a political uncertainty in Malaysia with regards to data center usages, and therefore that is actually causing a weak leasing environment for Keppel DC. Yeah, so this data center, the occupancy has been at 63% for past 4 years. Yeah. And initially it was actually 100% leased, but I think at the end of the natural expiry of the lease, it was subsequently released at about 63%. So, because of the sensitivity of the kind of tenants, the profile or who the tenants are for data center tenants in particular. So, Keppel DC actually does not share who is a tenant, or like is it an expansion or not, or new tenants. But then if you look at the number of tenants that were leased, this asset was leased to, it was 1 when it was leased at 100%, and it's 1 when it's leased at 63%. So it could either be that it was downsized, or the tenant downsized, or it was released subsequently at a lower occupancy. Yeah, I hope that helps. Second question for me would be about FCT. What are the properties of FCT's portfolio? What are the properties that FCT's property valuation dropped? Okay, so the answer to this question is out of their 9 retail assets, only 2 assets actually had a valuation drop. That was Changi City Point as well as Yishun Retail Podium. So for Changi City Point, the valuation dip was about 3.8%, and that was due to, I think, largely due to the weaker leasing at Changi City Point. So if you recall earlier, I mentioned that there was a 3%, the reversions were negative 9.8%. So of course, if you're looking at if you're doing a discounted cash flow valuation for this asset, that will actually translate into lower rentals collected in subsequent periods. So by discounting that cash flow, it will then result in a lower valuation. But of course, when valuers value these kind of assets, they will look at both the discounted cash flow as well as they will use a cap rate. So for cap rate wise, right, it is stable for all the assets. So the only change would be from the discounted cash flow, meaning the actual cash flow coming from the rentals. Second asset would be the Yishun 10 Retail Podium. So this is a very, very small asset. It's only valued at $33 million. So it's a bit it's not very significant towards this whole portfolio. Valuation fell by about 5.7%. So Yishun Retail 10 Podium, one of the major tenants there is actually Golden Village, the cinema operator. So it, with the reduced footfall coming through Yishun 10 due to, of course, capacity constraints with regard to cinema operations, etc., that could have resulted in a weaker leasing outlook for this asset. Yeah, so I hope that answers your question. For the remainder assets, right, most of them have no valuation change. 1, 2, 3, 4, 5, 6 of them have no valuation change, while Causeway Point actually registered a 0.5% increase in valuation. So that's about 11 million, if I'm not wrong, or 7 or 11 million. Yeah. Okay, that's all for me.
Okay, I think the next top ranked question. This question is on SPH. As the offer by Keppel consists of shares plus cash, if the share price of SPH REIT and Keppel REIT goes up, and Keppel does not revise the cash component up, would it make Keppel offer higher just based on the higher price of the shares? So the short answer to your question is yes. If assuming the offer by Keppel remain the same, then the share price of SPH REIT and Keppel REIT goes up, then naturally, just based on the existing offer, the share price, the offer by Keppel will be higher. But we also, I think what is worth noting is because of the expected pressure, selling pressure from SPH or from the shareholders for SPH REIT and Keppel REIT, the share price has remained, there's a little bit of a discount on the share price. So because of the new offer, only then we saw the share price rally a little bit higher. So we don't think that Keppel will stick to this offer, the existing offer, because the reason why SPH REIT and Keppel REIT rallied was based on the premise that Keppel would likely revise the offer, likely to be likely to have a higher cash component, and so the two the two entities, the SPH REIT and Keppel REIT value. So I hope I answered your question. I'll just continue to scroll down to see if there's any more questions. Yep, there's no more questions. I'll hand back the time to my colleagues.
I'll take the question on Xiaomi's market share. So recently, for the latest quarter, third quarter of this year, Apple actually overtook Xiaomi in the global smartphone market share, mainly due to the demand for iPhone 13. But actually, Xiaomi's unit sales actually fell 7% for the quarter, whereas Apple's one gained about 14%. So Apple actually grew and Xiaomi actually fell for the quarter. So I think we're seeing that a lot of the smaller companies, including Xiaomi, I think they are sort of more affected by the supply chain constraints than Apple, because the suppliers are sort of prioritizing Apple because of their higher volumes and higher values, higher value sales of their iPhone, because it can charge more for the iPhone. But also do take note that Xiaomi is in the sort of mass market kind of models, whereas Apple is in a higher end smartphone model. So they are sort of in a different kind of smartphone market as well. So we think that although Xiaomi may be selling more units than Apple, but those units are like a mass market unit, so may not really affect Apple's sales that much. There's another question about will you guys be covering the fundamental analysis for Microsoft and Google? This one, we may look at it and we may initiate it in the coming future. Okay, that's all from me.
Hello, Vivian here. I will take two questions. The first one relating to Japfa. So the question is the worst behind Japfa as more people are vaccinated in Vietnam and Indonesia, and demand is expected to pick up as the countries are less likely to lock down again? Yes, you're right. So I think with the vaccination rates ramping up in Vietnam and Indonesia, and also cases falling and the reopening underway, then we could expect the demand to pick up and also the prices to stabilize. For the second part of the question, what determines the selling price of Japfa products in Vietnam and Indonesia? Does the company have pricing power in an inflationary environment? Sorry, really can't really help on that. Don't really have an idea, but would be good to take note that for Japfa, actually their main products include the sales of the animal feed and also animal protein, and the feed sales have actually been the pillar of the profitability. So if you notice in the presentation earlier on, with the broiler prices falling below cost and they suffered losses on that, but for the feed, they have continued to remain profitable in that aspect, even though margins were tightened due to high raw material costs. Yeah, so hope that helps. And the second question is relating to Coda. So do you know of any reason that could explain the recent weakness in the share price of Coda, and is your buy rating for this counter still stay? So for Coda, no specific reason on the recent share price weakness. I think mainly it could be due to the low liquidity. And yes, our buy rating still stays. Demand is still very strong for their furniture exports, mainly due to the demand from North America. And on the supply side, I think with also the ramping up of the vaccination rates, they have resumed Malaysia operations at full scale, 100%. And for Vietnam, I think the last time they updated was about 50%. And with the continuous ramping up of the vaccination rates, I think it would be reasonable to say that we can continue to expect they would be ramping up the operating capacity. Yep. So that's all for me. Thank you. I'll be passing the time back to the other colleagues. Wei-Ren, do you have anything else? Otherwise, maybe you could end the webinar here.
Do not have anything else at the moment. Those who ask about the US market outlook today, yes, there is, and I posted it in the Telegram channel earlier on, so you can just register a link from there. Also, those who are registered before, you should be getting a link via to your email at 12 p.m. earlier on. So yeah, yeah, that's all. I think that's all for today. So if there's anybody still I mean, I pass my time to my other colleague. If there's no more question, I think I'll just we will just end our webinar.